Some people call it Friday. I call it Fry-yay. Welcome to the show. Good morning. This is the Street's Opening Bell Show here from Post 35 on the floor of the NYSE. I'm JD Durkin. That's at least what the blue box in the corner of the screen says. Opening bell rung moments ago by Harry's in celebration of the company's 50th anniversary. Happy 50th to them. Let's take a look at how the major averages are kicking off this Friday. Stocks are trading lower. That was the pre-market contracts. Anyway, this is Wall Street looks to notch its second consecutive week of losses. Not that it wants to have its second consecutive week of losses, but that could be what we're in for by the end of today's session. All this comes after the Fed raised interest rates 50 basis points for the federal funds rate, and recent retail data showed slowing sales, sparking fears of a looming U.S. recession. You've seen the CEO surveys. CEO after CEO after CEO says we will be in for a recession if, of course, we're not already in one. But the reason we do the show is to give you context and perspective about what all this dizzying array of headlines in the world of economics means for you. And to get smarter together, let's take a look for what is on tap for this morning's broadcast. We will talk markets as Wall Street looks to kick off the quadruple witching hour of the year. That is a heck of a phrase, and I'm very appreciative it's a part of our show. Plus, we'll dig into Elon Musk's suspension of several journalists on Twitter. I can't believe this is a real story. After so-called doxing coverage, Elon Musk is alleging that they doxed him. The truth is somewhere in the middle. It's a messy situation. And finally, Meta gets a rare upgrade from a major bank after a pretty brutal year. For more on those stories and so much more on this Friday, we now welcome in our senior editor, our chief markets correspondent, our chief Friday markets correspondent, Mr. Martin Baccardax. Martin, good morning. Listen, I've got nuances and things to dig into here for retail sales. I'm just going to start with an open invitation to tell me what are you thinking about? What is on your mind as we hit 9:33 on this trading Friday?
Well, it doesn't look like we're deeply in the red. I thought actually we were going to start off with some significant losses, but right now it looks okay. I'm checking the board. The S&P 500 is down about 20 points. That's about half of the projection. It's still going to look weak today, I think, and markets are absolutely now sort of transitioning away from their focus on the Federal Reserve's rate path and the implications of that rate path on the economy. So now, in other words, we're moving from inflation into recession. I really don't believe that there are many investors left who have much doubt about where inflation is headed. It's going to slow. That's an arithmetic certainty into next year. That has been brushed aside. Right now, we have to understand the impact it's going to have on consumers, it's going to have on business investment, and ultimately, JD, how those are going to add up to impact corporate earnings. And ultimately, the recession talk is going to be as associated with earnings growth as it is going to be with economic growth, because, of course, it's again worth reiterating that stocks reflect what's happening in about 12 to 18 months' time, as opposed to what's happening right now. So we are going to see this weakness, I should imagine, as an indication of where we see corporate profitability into 2023. And that, of course, is going to be predicated on what the economy does in terms of performance and how consumers react. So all of that together does suggest weakness, but I am a little bit surprised that we are not further down in the early part of the trading session. Not that I want to be, but I ultimately think that we're going to get a bit more selling, but it's just not materializing right now.
Arithmetic certainty is an incredible phrase. It's also what I would like to rename this show moving forward, because I always like when you put things into those terms. So it sounds to me as if you are not surprised that we've had the sell-off, and what a notable sell-off we had. It was an outright rout across the indexes. That was the similar story. North of 2%, I believe, of a sell-off for the S&P and the Dow, more than 3% for the NASDAQ yesterday. Is that in line with your expectations? Given what we heard from Mr. Powell this week, the short-term prognosis pretty good. Hey, people wanted 50, you get 50. The problem is where we go from here and how long they stay there for.
No, that's exactly right. I think there was a little bit of surprise with respect to the tone that Mr. Powell took during his press conference with the media after that 50 basis point rate hike. The assumption was that maybe he was going to see the softening inflation data, the weakening economic forecast, and say to himself, maybe we'll just tone it down a bit with regards to how quickly and to what level we're going to raise interest rates. He did not. He said that the economy needed these further hikes. We're pricing in another 3/4 of a point between now and March. And it needs it because without a successful inflation fight, the economic prospects would actually get worse. Now, on that score, he is absolutely correct. But I think what people are worried about is whether or not the Fed's blunt instrument of interest rate hikes is what's necessary to tame an inflation story which is largely built on supply chain disruptions. So that's more of a philosophical than an economic debate to a certain degree, because it's not going to change the Fed's mind, but that might be sort of expressed in the disappointment that markets had. And when I say disappointment, we generally talk through the prism of equity markets, but it is worth noting that capital in and around financial markets all over the world tends to move sideways as opposed to in and out. So if there are losses in one particular asset class, there are gains in another. The money doesn't disappear, as we sometimes describe it. It is just reallocated in different portions. I think that's an important point to make this morning, JD, because there was a fascinating survey from Bank of America. They publish each month a survey of the biggest fund managers around the world who collectively control a bit more than $500 billion worth of assets. So their decisions are exceedingly important in terms of understanding market direction. What they said was actually their indication of bullishness and bearishness is at the highest since March of last year. In other words, they are actually starting to see value in these beaten down stock markets because they assume that the worst has already been priced in. And as a result, they're seeing significant inflows into value funds and into stocks that have that pricing power that we've talked about on so many occasions. Now, at the same time, they fully anticipate a hard landing for the US economy, if not in the first half, certainly in the second. But that doesn't mean that stocks are going to underperform. And actually, they describe it as Wall Street versus Main Street. In other words, whilst Main Street is probably going to bear the brunt of this hopefully shallow recession, stocks may actually outperform. And this is exactly where professional investors bring their mettle to the market. They can bring that intelligence and that execution and generate value for people who are paying attention. So hopefully those who are watching the show this morning understand that weakness today does not necessarily mean sustained weakness going forward. Sometimes it's a value proposition, and the smartest money managers in the world are saying exactly that today.
If there is to be a so-called Santa Claus rally, I believe you previously told me we usually look for around December 22nd or so. We would be within a trading week. Are the underlying conditions there for a potential bump for the end of the year? Or, my goodness, are there just, you think, a little too many headaches and headwinds? See what I did there? Headaches and headwinds for investors to digest. Speaking of digest, it's like a lot of indigestion I feel like we're still going through from Wednesday's announcement.
Yeah, I think so too. Generally, JD, that Santa Claus rally takes place in the days after the Christmas break and the first couple of days of the new year. And it's just one that has a pretty extraordinary record, even though there's not necessarily a great deal of fundamental sort of basis behind it. But what was interesting last night, and what may prevent that rally from materializing this year, is that the S&P 500 closed below a reasonably important technical level. It's not worth getting into the reasons why that level is so, but the 3,900 point mark was something that had been benchmarked by a lot of market observers. And if it wasn't able to be sustained yesterday, there's a chance that the selling could accelerate into the Christmas holidays. And I think that's what we're seeing this morning. Of course, we'll get a better understanding in the next couple of days. And there is every chance that we'll get modest gains going into the end of the year in what is often referred to as window dressing, in which fund managers kind of put their best positions forward or attempt to sort of disguise losses or just paint the best picture that they possibly can for their portfolios. So we may see a little bit of that. I don't imagine it's going to be a significant run-up. I think that will likely take place in the early part of next year. There will be bumps in the road as we get earnings forecasts from the banking sector in mid-January. But I don't know that the conditions are in place for something sustained. I think we're going to have some even activity over the next weeks and potentially months. But then I do believe that value proposition will kick in, and that's when we could see a better performance in 2023 for the broader U.S. indices.
Martin, the quadruple witching hour is upon us. For those who don't know, Can you break down what this is? Why does it matter?
It's an interesting little quirk in the marketplace. It happens 4 times a year. Essentially, what you get is the expiry of futures contracts and options contracts. And you have those expiring on stock indices and single stock names. So it's called quadruple because you have 2 expiries in futures and 2 expiries in options. And it happens in the latter part of the session. So once there's a bit of cleaning up around that expiry and the people who are on the opposite side of successful trades kind of deliver the losses or the profits that are required. There's buying and selling of stocks on the back of that to get everything back into line. So you generally have a spike in volatility over the final hours of trading as a result. It's less significant now than it has been, of course, because the program trading, the algorithms and the flash boys and everything else have smoothed out those lumps. And actually, a lot of the trading takes place prior to the expiration of those options. But it still does elicit a little bit more activity as a result. And what we saw this morning, JD, was the VIX index, which is the CBOE's chief volatility gauge, jumped 12% overnight and another 2.5% in early trading. What it's predicting now is daily movements of between 50 and 60 points for the S&P 500 over the next 30 days. And that's elevated volatility for sure, certainly compared to a few weeks ago. I would imagine that is absolutely traced to the options expiry. It will likely smooth out into the start of next week, but of course then volumes are going to tail off significantly because we're heading into the Christmas holiday.
Yeah, we could also be very well heading into a recession, as we know. I wonder, are we starting to see movements one way or the other from either recession vulnerable or recession proof companies? I'm starting to see some headlines about some names that could be, potential picks. Granted, neither you nor I are financial advisors here, but we certainly know what portfolio managers are doing to prepare their clients for the path ahead. Or is it too soon to start talking about those companies that could do well or could do poorly because of a recessionary environment?
No, I think we're starting to see that represented in markets for certain, JD. The defensive stocks, certainly in the healthcare space, in the utility space, companies with significant cash flows and with free cash flow that offers a cushion against margin compression. That's incredibly important in a market like this. If you are someone who is interested in picking individual stocks, free cash flow is absolutely the metric to focus upon, particularly when you are, again, seeing these profit margins compressed by high levels of inflation and a pullback in consumer spending. But you do want to look into sectors that have the ability to weather the kind of economic downturn that we are expecting. And they do tend to be in that defensive space. They're not always the most exciting, but they certainly are worth looking at in a situation like this. And again, healthcare and utilities are certainly some of the most, they're the go-tos in these situations.
Martin, what's the latest with regards to the bond market and why is it so crucial to watch?
The bond market has been a really interesting and, in my view, underreported story for the past several months. Because it has been so predictive of where we are headed, both in interest rate terms and in terms of the broader economic conditions. They've been flashing the recession warning sign really since the early spring and continue to do so this morning. And I actually wrote a piece yesterday describing the fact that the bond markets do seem to be the only challenge to the Fed consensus at this point, because they're simply not buying in to the assumption that rates are going to have to stay at 5.1% for an elevated period of time. We're seeing two-year Treasury bond yields trade at around 4.25%. That's a long way from 5.1%, even after the Fed has told us that's exactly where they're going to go and that's where they're going to stay. The bond market is simply not accepting that and is trading against it as such. We're seeing that in 10-year bond yields as well. And the yield curve, difference between two-year and 10-year Treasuries, continues to remain steeply inverted and indicative of recession. So we are watching that very, very closely. And I do believe in these situations, the bond market can represent the broader, if you will, esprit de corps of, to take a phrase, of financial markets around the world. The Treasury market is incredibly deep, incredibly liquid, and certainly incredibly influential in changing the minds of Fed governors. It's early days, but I think the fact that there's such a distance between two-year yields and the Fed funds predicted rate, that something is going to have to give. Don't fight the Fed is very often the repeated mantra, but the bond market has a pretty good track record in doing just that, and they've drawn a line in the sand.
Yeah, that's awesome. Awesome context there. We did get a lot of important data here to digest this week, as recently as just yesterday, and of course, preceding the Fed's announcement. What were some of your big takeaways on the big data points for the week that was?
Well, there were quite a few of them, and they do seem to have all turned into weakening conditions. Certainly retail sales is probably the most arresting. I think it was a little bit of a surprise to see that declining gasoline prices. And JD, I saw numbers this morning saying that we're under $3 a gallon on a national average for the first time, I think in more than 2 years. And that's certainly welcome news. But even that decline in gas prices didn't elicit a spike in discretionary spending. Typically, the money that you're not putting into the gas tank finds its way into the real economy. And that certainly wasn't the case in the month of November, and very well likely may not be the case in December as well. And if you are looking at that kind of discretionary spending pullback, it does tell me that people are more worried about their job security and their job prospects, and therefore they're unlikely to extend themselves going into next year. There was economic activity data as well, both in the United States and in Europe, that was extremely troubling. Europe's activity has contracted now, JD, for 6 consecutive months. And the suspicion is that if they are not already in recession over there, they're very close to it, and they're also facing an energy crisis. And against all this, JD, the European Central Bank has said, we are raising rates, we're going to raise them even higher, and you, the marketplace, have not appreciated how high we're going to need to go to fight this inflation problem. I think that was a really stark set of messages from Christine Lagarde yesterday, and part of the reason why we have the sell-off in the United States and again this morning here in Europe. So central banks are tightening into these weakening economic conditions. And that is not the kind of mix that generally gives you a great deal of confidence in terms of financial market performance.
I know it's only Friday, and there's a well-deserved weekend ahead for you, Martin, really for all of us. But I wonder, as you take a look to next week, is there anything that's top of mind for you or should be top of mind for investors, just to sort of begin to set the stage for what investors may expect as they come in Monday, after watching football?
I think gratefully investors are going to find themselves in a bit of a glide path between now and the early part of January, simply because we're heading into that Christmas break period where volumes are traditionally low, and most people would like to avoid the kind of headline activity that generates the sort of trading volatility that has characterized the last 2 or 3 months. There really isn't that much on the horizon. We'll have shortened trading days next week and the following week, and then it won't be long after that before we start to get the material information that we're going to be required. Early January, we'll have Tesla delivery figures for the fourth quarter. Very shortly after that, we'll get fourth quarter earnings from the biggest US investment banks. And then beyond that, we'll get into the teeth of the fourth quarter earnings season reasonably quickly. We'll have jobs data, of course, in the beginning of January, and then inflation readings shortly after that, including the PCE price index, which is the Fed's preferred gauge. So there's everything to play for in the early parts of January, but I think investors will actually take a sigh of relief. We're over the Fed hump with PMI data today, and of course, quadruple witching hour at the end of the session. After that, I really do believe that we're into a glide path, probably a gentle upswing into the new year, and then everybody comes back rested and ready to play.
All right, let's dig into Twitter, because this has been one of the topics I've been most excited to talk about with you today. What a remarkable night. There's also other words that you could use to describe it. Remarkable is one of them, where one after the other, journalists who cover Elon Musk or who have tweeted critical things of Elon Musk were deplatformed, permanently suspended out of nowhere. Let's start at the top. What's your reaction to this? These are some pretty big names in the world of at least political journalism.
Yeah. I have mixed emotions about this one, JD. I'm certainly not one to step in and defend Elon Musk, because some of his activities of late have been indefensible and quite frankly erratic. And I really do hope that they aren't part of a pattern that's going to destroy what I certainly think is an incredibly valuable resource for journalists, for regular citizens, for anybody else who's interested in communication writ large. I think it's an incredible tool. I think it's an undervalued one, and I think if it can be monetized, it has just absolutely enormous potential. But what he's doing with it now at the moment seems capricious at best and petty and vindictive at worst. That all said, I do think he has one underlying point. But let's go back to the top story. Essentially, just as you described, he is suspending some journalists for a short period of time as a result of what they say is critical coverage, and what he says is actually publishing public information about his movements, specifically tied to his private jet. And of course, the private jet's movements are tracked by publicly available data and were published for many, many years by a young student I believe his name is Jack Sweeney, but please don't hold me to that. Musk has tried to shut that account down for a number of years. He doesn't like the fact that his jet is being tracked. He's always described it as a security risk. And earlier this week, he said that a car that was carrying his son was being stalked by someone of an unsavory reputation who thought Musk was in the car. And he thought he was in the car based on the data that was provided by that jet tracking service. So he was understandably upset and quite reasonably very worried about the safety of his family as a result of this, and took probably over dramatic action in suspending people who are using that information on the platform. People describe it as doxing. Basically, we're using information that may be public or private and putting it into the public sphere in order to either sort of embarrass or engender a type of an action against a person with whom you disagree. Doxing is actually quite, it has been a really uncomfortable tactic that people on both sides of the political spectrum have used against their enemies. And I don't find it particularly edifying. So to that degree, I do think that Musk has at least one kernel of defense in his decision to suspend the accounts of people who are sharing the information. However, it is capricious, and he hasn't used it in a consistent manner across the board. And suspending journalists, particularly at high-profile outlets such as the New York Times, Washington Post, CNN, and others, is simply a bad look. And he should know better, and the people who were advising him should know better as well. I'm very hopeful that they can come to an agreement on this and get back into sharing information on a platform that's incredibly important and doing the reporting work that we all understand is necessary in a democracy. But in this instance, you have a CEO who is he's been taken to make decisions quickly and rashly, and you have journalists who have been quite happy to goad him along the way.
So, okay, so that's an interesting, it's an interesting distinction. So I said permanently suspended because that's largely the chatter, but to be fair, to your point, you know, if you pull up these accounts, I'm looking at Aaron Rupar, who used to be with Vox, now an independent journalist, nearly 800,000 followers. 800,000 followers on Twitter the man has. And his page now says account suspended. Really he's an excellent follow. I mean, admittedly, if people want to know, if you don't know Aaron, I don't think he would mind me saying it. He leans left. He's always been a bit of an anti-Trump voice. He tries to hold accountable Republicans who go on Fox News, and he tends to call out, and he gets massive reactions on Twitter from these cable news clips that he posts. And if you go to these accounts, it says account suspended. Twitter suspends accounts that violate the Twitter rules. So obviously, that's the first part of it, right? The rules of Twitter, the terms of service, are changing by the day. Yes. But this, and I do want to clarify on this Elon jet thing for people that are seeing this and may not fully understand. This is publicly available information. It's just that this young man, Jack Sweeney, was basically smart enough to take that information and build a wildly popular series of accounts where he would show maps and give information about, and by the way, it's not just Elon Musk. He's done this with Jeff Bezos and other world leaders too, but Elon is like the most prominent one. So he is taking this information. It's just that Elon Musk doesn't want that information on Twitter. Is that a fair read?
I think it is. I think it is. I think sometimes where I would push back only ever so slightly is that there is lots of public information that I think we should all agree shouldn't be amplified. All of our home addresses are public information. I wouldn't like those to be splattered on Twitter anytime somebody disagreed with something that I said about the potential performance of Tesla stock, for instance. So to that degree, again, I have a kernel of sympathy for Musk's position in this regard. But at the end of the day, I think there are better ways to manage the risks associated with that than simply blanket bans, particularly when they only seem to apply to journalists who are overtly critical of your broader management skills in both the company and elsewhere.
Yeah, and other accounts that people may know, Donny O'Sullivan from CNN, who has just really been just an incredible political correspondent, really covering, I would argue, more of the right wing of MAGA country for CNN the last couple of years, and he's a very popular figure in media. And then, of course, Keith Olbermann for many years. I mean, he's no longer on Twitter. Keith Olbermann made his career bouncing back and forth between ESPN and MSNBC, also a pretty firm anti-Trump voice. I don't know. It's pretty amazing from where we go over here. Now, Elon Musk took over the company. He was very vocal about his commitment to free speech absolutism. You and I have talked about that. We've also joked about it a number of times. But Is there another argument in his defense to say Twitter is now a privately held media company and they can do whatever they want? Which I don't like to say as a journalist, right? This has a chilling effect. Any public platform, you say these journalists cannot be on. I think you and I as journalists would disagree with that, but Twitter can also do whatever it wants, right?
Yeah, this is where it gets thorny, and I think, and where we can really get semantic with respect to what we anticipate or what we assume are the rights of different media enterprises. I mean, gosh, I feel just a pang of anxiety coming over me as I mention these words. But the Hunter Biden laptop story, it wasn't obviously given similar amplification in media outlets across the country. The amplification was very much based on the kind of political leaning that the organ itself had. So that is a great example of those media companies taking decisions to publish, in inverted commas, whatever they want. The New York Times didn't give it nearly as much attention as Fox News did. In both situations, those organizations were perfectly within their rights to take those decisions. I don't criticize either of them for it, presuming, of course, that the reporting from each is accurate. So to that degree, yes, I think that Twitter does have some freedom, and certainly more freedom than we would like to admit, in terms of what it will allow on its platform. Now, there is a corollary inside what I've just said, and that's the fact that actually tech companies have been, for the most part, not liable for the materials that appear on their platforms in the way that the New York Times or other media outlets are. It's as the result of these Section 230 protections that have been in place for a couple of decades and are going to be changing, one can hope, reasonably soon. The tech companies have been afforded this protection, and their critics say they use it to allow hate speech and other horrible things onto platforms that would otherwise be taken down if they were directly responsible for it. Because they are not, people say tech companies are happy to leave it up because it simply engenders traffic in a way that, again, the New York Times and other companies simply couldn't do. So they can do what they like, but they have to do what they like as well, understanding the benefits that they're receiving from lawmakers right now, and the fact that those benefits are very unlikely to last too far into the future.
Yeah, of course, Twitter has already faced an exodus of advertisers from the platform, though for whatever it's worth, Martin, this morning when I was on Twitter, I did see an ad for Apple. Apple's back on. We know that was a contentious back and forth with. By the way, I think the Apple Twitter thing is going to be incredible because there's some speculation from some to say, well, what happens if Apple decides at some point to say, Twitter is in violation of our terms of service, right? Because now they're going to do this new Twitter Blue thing where there's an $8 subscription, but if you use an Apple iPhone, they're going to charge you $11, if I'm not mistaken, to compensate for that 30%, right? So it's a little bit of a dig back at Apple, and people are wondering whether Tim Cook digs right back, or more than likely, I think he plays the game. He's like the ultimate game player in a positive way, right? He smooths things over for the betterment of his fiduciary responsibility. But is Musk driving the platform further and further from reaching profitability with either all the controversies we're talking about now, or the fact that the man tweets some truly bonkers off the wall things? I mean, he's going for something. I'm just not quite clear what it is.
Well, you raised such an excellent point, and I'm really glad you did, because I omitted it in everything that I was describing in that soliloquy that I just delivered. I mean, at the end of the day, particularly in a country like the United States, but certainly in most countries around the world, it's going to come down to dollars and cents. And it is absolutely true to say that it doesn't make business sense for Elon Musk to be acting in this way, because, as you rightly say, he needs to bring advertisers into the platform, and he needs to entice people to traffic, because by definition, they want their views amplified on the platform, and their views are likely important enough to have people want to engage with them. If those people are put off by the actions of Mr. Musk and others, they're going to be less inclined to pay for Twitter Blue. Advertisers, as a result, are going to be less inclined to spend money on the platform as a result of that. We're already seeing, and we have seen for a number of months now, report after report of a pullback in advertising spending. Only yesterday, there was a report from Digiday that said advertisers were actually asking for money back from Netflix because their paid platform, their advertising paid platform, wasn't building the kind of audience that would necessitate the kind of marketing spend. So even the best of platforms with content that nobody could find objectionable is finding it difficult to get the kind of advertising spending that will create profitability. You can imagine how difficult that is for Twitter right now, and even more so considering the fact that they're so indebted. $13 billion worth of expensive loans and bonds were used as part of the leverage for the financing of Elon Musk's purchase, and he's had to sell about $40 billion worth of Tesla shares already this year, not all of it to buy Twitter, but certainly a good portion of it to do so. So this doesn't come without any economic cost, and if he continues to behave this way, the cost is only going to intensify next year.
Yeah, absolutely. This is a fascinating conversation, and I actually hope it's one that as we move forward in the next few weeks, Martin, that you and I are able at some point of every broadcast here to kind of dig into, because I know the one argument says, well, percentage-wise, very few Americans are actually on Twitter, which I don't disagree with, and it's something that we tend to over-index and over-focus on. But when you're talking about a man who is essentially putting us on the moon, building tunnels underground, building plants or chips to implant in our brain, and what else am I forgetting? Oh, is like the world leader in electric vehicles.
Claims to want to send us to Mars, claims to build tunnels, claims to put chips in our brains. Delivery and claim, there tends to be quite some distance between those two.
Well, that's true. That's true. But of course, the Artemis missions for NASA already have the contracts here for a company like SpaceX. It is actually the lunar module that will land us back on the moon is going to be his company. But you're right. There's a difference between claims and what he says. And so I bring all that up to say, I think it is important to still track what the man does in the media space. Sure. Because he is arguably the most important person in the world. If someone made that claim, it would be an interesting debate. So that's why we cover it. I hope we can continue to cover it in good faith from time to time, because it is important, even to those, I argue, who aren't on Twitter. And if you're not on Twitter, I envy you, and I envy what you do with your spare time. All right, time now for our rapid fire section. Let's talk JP Morgan here up first here. Martin, why did that company give Meta a rare upgrade? What?
Yeah, I tell you what, it's been a long time since we've seen positive Meta news, no doubt about it. But JP Morgan this morning, their analyst gave it an upgrade. They upgraded the stock to overweight from neutral, and they actually boosted their price target to $150 a share, essentially saying that Meta has got their arms around cost control, and that's a good thing heading into 2023 when, of course, advertising spending is going to slow and they're going to have to squeeze more profits out of slimming ad dollars on Facebook and Instagram. And they also say that the impact of Apple's privacy changes is also starting to abate as well. You'll remember that last year, Apple put in place restrictions that prevent companies like Facebook, Instagram, and others from tracking their users' activities across different apps. And as a result, it's become more difficult to give them targeted advertising. And that's had a corresponding decline in ad spend, because who wants to throw money at the wall? You want to make sure that if you are spending on ads, it's going to get in front of the eyes that you want. So that's had an impact. Slow ad spend and slow user growth has also had an impact, and the competition that, of course, has been brought by TikTok. But if there is the potential for TikTok to be banned in the United States, or potentially even truncated to some degree, that will certainly be of benefit for Meta next year. And the cost cuts, not only with respect to Meta's broader business, but the fact that it's likely to lay off 11,000 people next year. They announced that only about 6 or 7 weeks ago, is something that JP Morgan says is going to give the stock a boost.
All right, let's move on here. Next, let's talk Mazars and Binance. By the way, the CZ Kevin O'Leary back and forth the last few days has been fascinating to watch. But to that point, it really has been, I mean, these interviews, just the last 48 hours, a dizzying array of the back and forth between the two of them. Next up, Mazars has paused all work with all crypto clients, including Binance. What does this mean specifically for CZ's crypto giant?
It's not good. It's not good for Binance, and it's not good for the broader crypto industry. Essentially, Binance was trying to generate a report that would assuage concerns that it is not backing on a one-to-one basis client deposits that are on the world's biggest crypto trading platform. They published something called proof of reserves, which isn't nearly the same thing as an audit. Proof of reserves is a very specific snapshot that Binance would like us to believe is indicative of probity across the whole of the business, and it is absolutely not. The only way we can have that is through a thorough and significant audit. Mazars, which is a France-based audit firm which has activities with companies all across the world, has said it's not going to carry on with audit activities linked to Binance. And as a result, they're not going to be able to publish the kind of detailed report that investors are looking for. We've seen a corresponding decline in Bitcoin prices overnight as a result, but this is only going to engender more questions about the safety of these trading platforms, the fact that they can operate largely outside of regulation, either in Europe or the United States, and all of this peels back into the collapse of FTX, as you just alluded to, and the ongoing attempt there to get to the truth behind what people have said is simply an out-and-out fraud.
Absolutely. Okay, third and finally, we talk unemployment a lot, more investment banking layoffs. Are companies preparing for a downturn, Martin?
Yeah, that's certainly how it seems. Reports this morning say Goldman Sachs is looking at cutting, I think it's about 8% of their workforce. At the worst, it could be about 4,000 layoffs. They have about 50,000 people globally in terms of their headcount. This might not get to that level, but there certainly is going to be a peel back. And this is the first time that Goldman, if the reports are true, has actually culled staff in 2 years. And the investment banks, I've always found, are very indicative of what is going to happen in the broader economy in the near term, because they are staffed to perfection. In other words, they have the kinds of headcount that really that are fully attuned to what they expect they can do in investment banking, in mortgage banking, and in commercial banking, and all the rest of it. And the moment that they feel that they can't justify those headcounts, they pull them back. So they can be very much an early precursor into what we're seeing both in the broader economy and the jobs market. And the Fed told us earlier this week they expect unemployment to rise to 4.6% by the end of next year. We're only at 3.7% right now. So there are jobs that are going to go, and we're starting to see it in evidence in the tech sector and now in the investment banking sector. And that's going to expand more broadly, unfortunately, as we head into 2023.
All right, Martin, we're just about out of time. What do you got? Oh, we got Dolphins Bills. That's a tomorrow night game. You guys are tomorrow night against Buffalo at 8:15. A Saturday. I love Saturday football, man. The NFL. I'm
Up
assuming
in the
you like
snow.
your Fins.
I know.
Yeah.
I know. It's not going to be carried by any affiliates down here either, JD. So I'm going to have to lay out some money to NFL.com in order to watch it, which is they need to deliver if I'm going to pay that $7.
Yeah, well said. I know the team has struggled more or less in temperatures where the kickoff temperature is under 40 degrees, if I'm not mistaken. Yeah. But I don't know. You guys got a special thing going on down there. People like the coach. They like the energy. One day we're going to have a good debate about TV distribution and the frustrations that come with it, because I'm dealing with it here with MSG. I can't watch the Knicks games very easily because I have Hulu. It's a whole big thing. One day we're going to have that debate and do a whole special on it, because users are getting squeezed out, man.
I can tell you, it is so much easier to watch Premiership football in the United States than it is in the United Kingdom, and that has never made any sense to me.
No way. All right, well, we've got that topic and many more coming for next week and the weeks ahead. The great Martin Baccardax, happy Friday to you, my friend. Thank you for all the incredible insight all week long. Enjoy your weekend. Go Dolphins, and I'll see you Monday.
You too. You're a good man. Thanks, JD.
You got it, brother. All right, that's going to do it for the Market Open here from the floor of the NYSE. Here it is, folks. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. Have a great weekend, and we'll see you Monday.